Welcome to this Nedbank Financial Market educational series, proudly brought to you by our online share trading division. In this educational series, we will discuss various topics related to financial markets. Learning about trading and investing is essential for every client, as this will equip you to make more informed personal trading and investing decisions. As a client, you want to make money. However, there's more to this than meets the eye. In this session, we will discuss share prices in more detail. There is a common saying, don't judge a book by its cover. An equally valid truism for the trader could be, don't judge a share by its share price. Many people incorrectly assume that a share with a low rand price is cheap, while one with a heftier price is expensive. In fact, a share's price says little about the share's value. Even more important, it says nothing at all about whether the share is headed higher or lower. This session will help you understand the basics of how equity markets work and why equities behave as they do. Please note, this session is on both a beginner and an intermediate level. Before we start, please refer to our disclaimer. In summary, you cannot regard this session as any trading or investment advice, as it is provided for educational purposes only. Let us commence the session. Firstly, let's consider whether or not to trade. If you're thinking about trading on the equity market and the thought of losing money upsets you, you probably should not trade. No one likes losing money. However, the endurance of some is greater than others. Before deciding to go ahead and trade, you need to understand that it is quite possible that there will be occasions when you will lose money. If you have considered your options and decided you do want to trade, there are several things you need to know that will increase your chances of trading successfully. Let's start by asking, what is a share price? A share price is the price of a single share of numerous saleable equity shares of a company. Simply put, the share price is the highest amount someone is willing to pay for a share, or the lowest amount that it can be bought for. The share price only tells you a company's current value or its market value, so the price represents how much the share trades at, or the price agreed upon by a buyer and a seller. So what determines share price values? A share price is established through the intensity of supply and demand. This means that the prices will rise when there are more buyers or a large demand, and the prices will fall when there are more sellers in the market or a large supply. If the share price increases for a consecutive period, we could potentially see the start of a bull market. Similarly, if share prices decrease suddenly, we could well be entering into a bear market. What is the equity market? The equity market is used to buy and sell shares in publicly traded companies. It is a complex system. For some people, the workings of the system are unclear, and they may regard it as a form of gambling, as when you trade in equities, you can both make and lose money. But in fact, it is not gambling at all. With gambling, there's a large degree of chance and luck involved, but when you trade in equities, if you take the time to do your research, you can increase the probability of making money on your trades, making it more about skill and knowledge than luck or chance. You could say that the equity market is made up of groups of people pitting their expertise against each other. What you should bear in mind is that the equity market is a hostile system of trading. It is made up of millions of traders and investors with entirely opposing views. For example, when one trader sells a particular share, someone else must be willing to buy it. If the traders have the same investment objective, then they can't both be right. In short, one trader will benefit and the other will suffer. It is therefore important for you to equip yourself with knowledge and ensure you become skilled in the various tools that are available to you when you are contemplating trading. Let's now discuss the law of supply and demand. This is a theory that explains the interaction between the sellers of a resource and the buyers of that resource. If a company produces a product that not many others produce, or a product that is highly desired or in demand, the price of its share will increase because the demand is high. When the supply of the goods balances out with the demand, share prices will tend to level. And if the supply is greater than the demand, the company's share price will likely drop. It also depends on how effectively and uniquely the company produces the goods. If they create a variation on an old standard, their share price may stay the same or increase, even if supply is high. In the end, it all comes down to the law of supply and demand. Let's discuss management or manufacturing changes briefly. Changes in management or manufacturing can cause a company's share price to rise or fall. It depends on how efficiently and professionally the company is managed and goods are produced. Changes to the management team, management style, or how goods are produced can boost efficiency and thus overall effectiveness, increasing profits and causing the share price to rise. However, changes that decrease profitability can result in the exact opposite effect. We must also keep track of a company's brand or good name. A rumor about a company or the achievements of a company can significantly affect its share price, particularly if the company is mentioned via social media or on the news or in the media. Rumors, true or untrue, can cause the company's share price to rise or drop simply through being associated with something positive or negative. Also, being connected to or responsible for a breakthrough, either in the market or a respective industry, can cause a share's price to increase or decrease. Now let's look at share prices, earnings, and shareholders. A company's share price is determined by that company's initial public offering when it listed its equities on the market in the first place. To determine what the share price should be, investment firms use a variety of metrics along with the total number of shares being offered. The earnings that can be expected from a company will cause the share price to rise or fall. The value of the company is constantly determined by financial metrics used by traders. These include the company's history of earnings, changes in product ranges and offerings, and the profit the company expects to make. This information will cause traders to bid share prices up or down. Traders and investors aim to make a return on their exposures, and this is done in two primary ways. Firstly, through dividends. If the company share pays dividends, regular payments are made to shareholders for every share held. Secondly, purchasing shares when they're at a low price and making a profit by selling them once the price goes up. So how can we assess share prices? Share prices can be effectively analyzed through technical and fundamental analysis. Technical analysis seeks to predict the future price movement of shares by looking at historical chart data. By studying previous share price trends, technical analysts can often identify whether a share is about to enter a bullish or a bearish trend. Fundamental analysis is more concerned with identifying whether the share is over or undervalued. It does this by analyzing the individual company's perceived ability to generate a profit, focusing, amongst other things, on macroeconomic data, financial statements, and decisions from senior management. Have you ever wondered what the benefits are for a company if its share price rises? Well, there are several reasons why a company would want its share price to rise. A high share price brings with it a certain amount of prestige, and it can discourage takeovers. As well as being able to generate large amounts of revenue for the company, it can also mean that senior management or employees in general might get a bonus. One way a company can encourage share price growth is by paying dividends to its shareholders as a reward for their investment. Dividends not only attract new investors, which will increase demand and drive the share price up, but also encourages current shareholders to keep their shares rather than selling them. This is good for the company because sell-offs can cause the price of a share to fall as the market adjusts to the increased supply. If a company ever wanted its share price to fall, perhaps to make the shares more accessible to investors, then it can issue a share split. Share splits will reduce the price of a company's share by increasing the supply of shares available on the market. For example, if a company issues a 2-for-1 share split, the total number of shares will double, which means that the price of each share will halve. However, share splits do not mean that the company's market capitalization will fall, because the reduction in the price of the share is proportionate to the amount of new shares that have been issued. Share prices are available for every publicly traded company. The share price reflects the company's market value, in other words, what the public is willing to pay for a piece of the company. Share prices can and will both rise and fall based on a variety of factors in the global landscape and within the company itself. Keeping up to date with technical and fundamental analysis on the companies you are interested in, and keeping an eye on reports in social media and news networks will equip you to make more informed personal trading and investing decisions. We have reached the end of this session. This educational video was brought to you by Nedbank Online Share Trading. Any examples used in this session are purely for illustrative purposes. Thank you for your time.